Right, well, no prizes for guessing who I am. Anthony Browne, Chief Executive of the British Bankers Association. And just picking up on David's point, it is a competitive market in the UK, and I noticed that from my customers, from my members rather. We have over 170 different members in the BBA. Half of them are British banks, half of them foreign banks, and they slug it out with each other all the time, fighting for customers. And I noticed on the way here that on the tube, a large number of adverts from banks all trying to steal or lure customers off each other. And I certainly think, just to set out at the beginning, that because we're often portrayed as a cartel at the BBA, just representing the big banks, we also have all the challenger banks as members, a lot of the small banks as members, and we are very much in favour of competition. And what I want to set out today is how we think the competition works in the market at the moment, in the banking market, and how it can be improved. And as both Brian and David said, there has been a lot of political focus in recent years on competition. In the wake of the financial crisis, clearly all the political debate was, quite understandably, how do we stop the financial crisis happening again? How do we make the whole system more stable? All the prudential regulation that came through, both at a UK level but more at an EU level. In the last few years, in the wake of all the various mis-selling scandals, there's been a lot more focus on making sure the industry delivers real value for customers and improves the level of services to customers. And the politicians from all political parties have picked up on competition as the solution to that. We need more competition to drive up standards. And as I say, that is something we support. Indeed, the current coalition government have done a lot of work on that. Labour, Ed Miliband made a lot of headlines a couple of weeks ago, introducing new proposals, which I'll come to on caps on market share. And indeed, this is a broad thrust of more competition, as I said, we support. We've got, what I'll lay out today is ideas on how we think that can work and what doesn't work. And I should start that the debate on competition normally starts on discussions, as it did with Ed Miliband, about market share. And this assertion that actually Britain's got an amazingly concentrated banking sector, far more concentrated elsewhere, and it needs to be broken up, etc., etc. But I've got a slight shock for you. Hopefully this will work. Ooh, there we go. We actually have one of the least concentrated banking sectors in the EU. There's lots of different ways of measuring concentration of banking, but we just took two indices here. There's the European Central Bank, this Herfindahl index, the share of total assets held by the 5 largest banks. And as you can see, UK, yes, it is more concentrated than Germany, one for the debate later. But it's less than France. It's way below the EU average, and obviously far, far less than the Netherlands there. In terms of the G7 economies, more broadly globally, World Bank produces figures on this. The share of assets of the 3 largest commercial banks, and again we're down the sort of bottom end of the league, as it were, third from the bottom. We are, whatever the issues around concentration in the banking sector, the UK does not have a uniquely concentrated banking sector by pretty much any measure. So the question then is, how does competition actually work in the banking sector? And again, the debate here tends to focus on market share, and I think a lot of that debate can be rather misleading, because banking isn't. Banks compete in lots of different markets, multiple different markets. You get credit cards from banks, current accounts, mortgages, personal loans, ISAs, and so on and so forth. And sometimes they compete with each other on offering those products. Sometimes they compete with people who aren't banks at all. And so you've got to think, when you're talking about competition, it isn't just Bank A versus Bank B. It's also all the other providers offering the same sort of service. So the figures here. We've counted 30 different credit card issuers in the UK, of which many are banks, but by no means all. 50 current account providers in total, which are banks, but some of them, the post office is opening up current accounts. You wouldn't normally think of that as banks, as well as the supermarkets like Tesco, which we'll come to. Mortgage providers, 60 or more, you can carry on counting. An incredibly competitive market. If anyone goes to moneysupermarket.com or whatever, we'll see. And again, banks are some of those, but you can get mortgages from lots of different people who don't classify as banks. Indeed, building societies, for example, but then lots of others. And then personal loan providers, probably the most competitive market of all. I mean, that's obviously there are banks in there, the payday lenders that have generated a lot of publicity. In fact, I think we can go to way over 100, because I know there's about 200 payday lenders. And then Obviously, I notice Hitachi Personal Finance are doing a lot of advertising at the moment on the tube, trying to win customers. So it's lots of different markets. The dynamics of competition aren't just Bank A versus Bank B, but it's in a far broader context. The graph there is just comes out from the Independent Commission on Banking, looking at how in different sectors of banks, the way banks operate, the market share that they've grabbed since 2007. It's a more interesting story in some parts of banking than it is in others, and some are more sort of overtly competitive in terms of changing market share than others. So the ultimate question, though, is what do customers get from this? Does it actually serve the customer interest? And I would argue that actually, on many measures, customers in the UK do very well out of the banking sector. This is just examples of what we have on the market at the moment. You've got some current accounts with earning 4% interest on the balance, which is actually far higher than the mortgages you can get at the moment, 3.7%, which is quite an extraordinary state of affairs brought about by competition. Personal loans, unsecured personal loans, 4.9%, which is very low by historical standards. For those of you with credit card debts, you can get interest-free credit card debts for 2.5 years. I mean, these are quite amazing offerings to customers, and certainly, presumably, customers benefit, or they absolutely do benefit from this. But customers aren't just interested in simple price; they're also interested in services, the level of customer service, internet banking, and so on. So the message that we have is, competition is complex in banking. There are a lot of competitors out there, but we are always in favour of more competition. It is good for customers. It helps drive up standards, helps deliver new services, helps encouraging innovation. So we should absolutely look at new ways to promote competition. But I'll start with the discussion on the market share caps, just because it's so topical in the last couple of weeks. Been non-stop coverage about it. The thing is about market share caps, they've actually been investigated before. These aren't new ideas that Labour have come out with. In fact, they were investigated quite at depth by the Independent Commission on Banking, the John Vickers Commission, and they looked at the two of the proposals that Labour came up with. So one is hiving off additional challenges above and beyond those required by the EU, so above and beyond the Lloyds Banking Group and RBS divestments. And they also looked at the idea of a market share cap, and they took a lot of evidence. This is a commission which, just to remind people, was not a stooge to banks. They brought in ring fencing. They had a lot of very strong independent-minded people on there. And on both cases, there's a slightly convoluted double negative in the first one, but if you read it a couple of times, you'll understand what they're saying. There is no evidence that actually additional divestment above and beyond that's already been happening would actually deliver real benefits, but would be costly. And then on market share caps, as I said, there is very limited. There's no evidence that actually market share caps really work. And I should say a lot of the debate that went on in the last couple of weeks about this was really quite misleading. I mean, for example, in the US, there's a lot of comparisons to market share caps in the US, where they have at federal level a 10% cap on assets held. At a state level, it's 30%. That only applies to mergers and acquisitions. It doesn't apply to organic growth, whereas the proposals a couple of weeks ago were meant to apply to organic growth. And the danger there is that it could be really actually anti-competitive and discourage competition. If you had a cap at, say, 20%, we don't know what the cap would be, but if you had a bank that was approaching that cap or had reached that cap, they wouldn't be allowed to take on any more customers. And in fact, they'd effectively have a sign on the front door saying, closed for business, no new customers allowed. And we would not benefit customers at all. It would not encourage banks to go out and innovate. It would not encourage banks to compete on price. It would not encourage banks to compete on customer service. You've got to make sure in encouraging competition that you do it in a way that actually benefits customers and doesn't hurt them. But don't listen to me about this. Listen to some of the other voices that came out about it when these proposals came out. Mark Carney, Governor of the Bank of England, he made the point to the Treasury Select Committee that actually breaking up institutions doesn't necessarily create a more competitive structure. It depends on how the competition actually works. Jane Angadia of Virgin Money, one of the most outspoken champions of challenger banks, again, they didn't come out in favour of customer cap at all. What matters is customer choice, having a level playing field, that market forces operate properly, even which, there's part of their quote there, they actually came out, the other part of the quote was actually coming out against the caps. But again, what matters is not caps on customers, but promoting competition, making it easier for banks to innovate, for banks to start up and grow. So you've got the voice of challenger banks and customers, and indeed the Governor of the Bank of England, all saying they don't believe in customer quotas or market share caps. And one other thing is the debate about all this. A lot of it was about branches and people adding up the number of branches that different banks have. And as David and Brian highlighted earlier, that when we have had divestments of branches here, there's not a huge market in people willing to buy up the branches. And there was an interesting quote here from Anthony Thompson, co-founder of Metro Bank, who said that branches are the wrong focus. It would be like forcing BT to reintroduce telephone boxes to the high street. Banks are, the footfall in branches are declining. This is one of the big debates in banking, is what do you do with the branch networks. People are moving a lot more to new technologies, mobile phones, internet, telephone banking and so on. And so really having a whole political debate focused on the number of branches is a debate focused on the past and a problem of the past, rather than a debate focused on what's happening at the moment, and indeed it's going to increasingly happen in the future. So the question we need to ask, if market share caps and customer quotas aren't the way to promote competition in banking, what is the right way to promote competition in banking? We think, if you look at the academic literature on competition, in the 1970s people focused very much on market share and as the sort of sole measure of it. In other sectors, there are also quite big concentrations, but also clearly very competitive. If you look at the supermarket sector in the UK, you've got big four supermarkets, got massive market share, but they clearly compete massively with each other. And indeed, if you're a farmer, you might argue they compete too much, but they compete with massive consumer benefit in terms of the range of products and prices and so on. So market share, there's far more goes on about competition that drives competition than simple market share. And the most, I'll take this going up from the bottom upwards, but the most important thing is that customers actually know what they're getting and they have information about that and they have different things that they can choose from, and that's sort of transparent information about different products, that they can switch between those products. If customers are trapped with one particular provider, then clearly it doesn't matter that banks are competing or other providers are competing. You also need to make sure that new entrants can come in. Reducing barriers to entry, should be possible for people to set up new banks, and reducing barriers to growth. That's having a level playing field between the different banks in the sector. So there's actually been, as I said at the beginning, this is not a new debate. It's been going on for quite a few years. There's been a lot of work in the last few years on promoting competition in the banking sector and the ways to do that. None of them have found in favour of customer quotas or market share caps. We had the Independent Commission on Banking, which I reported earlier, which came out with quite a few recommendations. We just had last year the Parliamentary Commission on Banking Standards, which also made quite a few recommendations relating to competition. We've had things like the Office of Fair Trading have did an investigation into the personal current account market, where they decided not to recommend to the Competition and Markets Authority. They're also now investigating SME lending. We'll wait to see what the outcome of that is. But the outcome of all these different investigations and government reforms are we've had, and a strong and effective challenger bank come from the Lloyds Banking Group divestiture, TSB. We've got Williams and Glyn coming down the line from RBS. We've introduced a new switching service, making it easier, CAS, the current account switching service, making it easier for customers to switch from one bank to another. And the FCA has become a very strong pro-competition regulator. It's got a duty to promote competition. It's set up a new competition unit, which it's got two co-heads of, which is working out how to promote competition in the banking sector. So this is the current account switch guarantee, which was obviously launched last year. A lot of publicity. So far, 300,000 people have used it to move from one bank account to another. As I said, that's one of the underpinnings of competition working, is making it easier to switch. Transparency of information. This is just one example, but there's been better information about bank charges, overdraft charges, and that has come down massively since 2007. It's saved £1 billion for customers. We have the new regulators. I mentioned the FCA already, but actually now the Prudential Regulation Authority has got as a result of the Banking Reform Bill, has now got a mandate to facilitate competition. They're now working out how to do that with their prudential remit. The government have also announced They want to set up a payments regulator, and again, that would have a competition remit that would set up under the FCA. There are concerns about the competition, the effect of the ownership of the payment system, the operation of the payment system on competition. So there's a huge regulatory drive towards promoting competition. But we've also, in consultation with members, looked at what can be done to promote competition. And the sort of discussions we're having, and it's all based on a level playing field. We just want the members to have a level playing field, no special favours for anyone in any particular sector. Simpler authorisation. The FCA, PRA have already doing that. We've been in discussions with them about that. Lower capital requirements in certain particular sectors. We don't want to lower sort of prudential stability, but there is question marks about the standard versus IRB models for prime mortgages, for example, that where challenger banks can face having 7 times as much capital for lower LTV mortgages than a main high street bank. Access to funding for lending, widening out to all operators. That is. Has happened to some extent, could do a bit more. Local authority deposit holdings. At the moment, all there's £30 billion of local authority deposits. They are all in the main high street banks because the advice and guidance given to them basically is that they should be in the high street banks. The argument here is that they should be able to use their own criteria for judging who they hold their deposits with. I mean, partly it's in the wake of the Icelandic banking crisis where quite a few of them got burnt, but there is a new regulatory regime in there now, and that's an issue that the Treasury and local authorities are looking at. There's one challenger bank that, so no challenger banks have any deposits from local authorities at the moment in the UK. One of them does bank the US government in the UK, and have pointed out that it's ironic that they have far more on deposit from the US government than they have from any public authorities in the UK. We've also, at the BBA, set up a challenger bank advisory panel just to look at issues around competition. So what's the impact of all this in the actual marketplace in the high street? You had a picture of the high street earlier. There are a lot of new players out there already, and this is the point we made when the debate about market share quotas was coming up a couple of weeks ago. And in addition to the main high street banks, the big 5, we've got TSB, obviously being hived off Lloyds, that's already out there in the high street. The Post Office and Virgin Money opening up current accounts. Tesco Bank opening up current accounts. Metro Bank out there very vociferously challenging the banking model, traditional banking model. Williams & Glyn is coming back, making a reappearance at some point. And then you've got some other more specialist niche providers such as Aldermore and Shawbrook, which provide focus on different sectors, but SME finance in particular. So there is a lot of activity out there, and these aren't tiny little operations that can't affect anyone. I mean, Post Office has got a very big network there. Tesco, big brand name. Ultimately, our message is that competition is a good thing. We should look at how to promote competition. There is already a lot of competition, but when we have a debate about competition, we should look to the future, not to the past. Don't talk about branches, which is, as I say, definitely looking back at old business models. The real game changer for competition is technology, which is completely transforming the way people interact with their banks, and will increasingly do so as new services are developed. Now, one example of this is the disruptive technologies of PayPal, Amazon Payments, and so on. And there was a survey recently in the US about what people thought of the sort of highest profile banks. This comes to your brand finance point. And when it came to payments, the number one way to make payments, everyone thought in the US, was PayPal, and way above any other banks. And it's these sort of disruptive technologies that will help competition in the banking sector and provide real competition. And when we have a debate about competition, we should look to what might happen in future rather than just focus on things in the past. The banking sector is also obviously using massive amounts of new technologies. We have, all the banks have got actually explosive use of mobile phones and iPads for banking, grown far quicker than internet banking ever did. From April, we're going to have, you'll be able to make payments to mobile phone numbers. So if you give me your mobile phone number, I'll be able to text you £20 or whatever, which will probably become a very common way of making payments from individual to individual, or indeed individual to company, or vice versa, and indeed has been, as lots of people know, a very popular way of making payments in Africa, but that's coming in just a few months' time. So the real way, I'm going to quote finish on a quote from John Fingleton, who used to be CEO of the Office of Fair Trading, that when thinking about competition, we shouldn't just think about the sort of old business model, the traditional business model, but actually try and think of rules that actually help innovation, help innovative providers, help new technologies, because ultimately that is what will, in the future, carry on driving technology. So ultimately, my message is, we have a lot of competition. It's an incredibly competitive sector already. We have an awful lot of providers already in the banking sector, competing with providers, other banks, but also competing with providers in different markets outside banks, such as credit cards and mortgages and personal loans. Competition is increasing, a huge regulatory pressure on to promote competition already. Market caps, don't think they work, could be counterproductive. But the ultimate winners of all this move towards more competition in the banking sector are the banks themselves. They'll become stronger, but in particular the bank's customers, who should benefit from new services and better prices. Thank you.